There are literally thousands of ETFs out there. And when you're just starting out, ready to finally get your money working for you, that number isn't just overwhelming, it's paralyzing. It feels like you're lost in a financial jungle with no map. But what if I told you that for your very first ETF, you can ignore almost all of them? What if the secret to getting started wasn't about digging up some hidden gem, but about embracing a simple, powerful, and dare I say, boring strategy? Staring at a list of thousands of funds feels impossible. So this video is your step-by-step guide to cutting through all that noise. By the end of this, you won't just know how to pick your first ETF. You'll understand the why behind it so deeply that you'll never feel lost again. It's time to get clear and get invested. Before we even whisper the name of a single ETF, we have to start with the most important person in this entire equation, you. The first step isn't about funds. It's about figuring out your personal goals and how much risk you're truly comfortable with. This isn't fluffy talk. It's the bedrock of your entire financial future. So, you have to ask yourself, why are you investing this money? Are you building long-term wealth for a retirement that's 30 or 40 years away? Saving for a down payment on a house you hope to buy in the next 5 years? Or are you just trying to fill a gap in a portfolio you've already got going? Your answer here changes everything. Long-term goals, like retirement, can handle more market volatility, the natural ups and downs, because you have decades for your money to recover and grow. Shorter-term goals, on the other hand, need more stability. And that brings us to risk. Think of risk as how much your investment's value is likely to swing around. Stocks are generally higher risk than bonds. An ETF holding thousands of stocks is way less risky than one holding just a dozen. As a beginner, your goal is not to chase the highest possible returns right out of the gate. The goal is to get in the game in a way that lets you sleep at night. For your very first ETF, your goal is almost certainly long-term wealth creation. That means you're looking for something that gives you broad exposure to the market and is built to grow steadily over many, many years. You want a foundational building block, not a lottery ticket. Keep that in mind. The mission is long-term, foundational growth. If you remember only one technical thing from this entire video, make it this: the expense ratio. This is the annual fee an ETF provider charges to manage the fund, and it's shown as a percentage of your investment. Here's how to think about it. If you invest $10,000 into an ETF with a 0.10% expense ratio, you're paying just $10 a year. But if that same ETF had a 1% expense ratio, you'd be paying $100 a year. Now, that might not sound like a huge deal, but this is where compounding, the most powerful force in finance, can silently work against you. Over time, these tiny-looking fees can devour a shocking amount of your money. Let's run the numbers. Imagine you invest $10,000 and it grows at an average of 8% per year for 20 years. In a fund with a low 0.25% expense ratio, you'd end up with about $30,451. But in a fund with a higher 1% expense ratio, you'd only have about $21,610. That's your money, just gone, eaten up by a fee that looked harmless on paper. This is why for your first ETF, the expense ratio is non-negotiable. So here's the rule. Look for broad market ETFs with expense ratios below 0.20%. And honestly, you should be aiming for funds under 0.10%. Some of the best and most popular ETFs have fees as low as 0.03%. For every $10,000 you invest in a fund like that, you're paying just $3 a year. It's amazing. Seriously, there is almost zero reason for a beginner to even look at an ETF with an expense ratio over 0.5%. Think about it. Cutting costs is the only free lunch in investing. It boosts your returns without adding a single ounce of risk. Getting this right is the key to starting your journey on the right foot. First, let's talk about broad market ETFs. These are the undisputed champions for beginners. A broad market ETF is designed to track a huge established market index, like the S&P 500 or a total world stock market index. Think of it as buying one share instantly gives you a tiny piece of hundreds or even thousands of different companies. The magic here is instant diversification. If one company or even one whole industry has a terrible year, its failure is cushioned by all the others in the fund. This makes them less volatile and the perfect foundation for your portfolio. They are simple, transparent, and super cheap. This is the boring but beautiful strategy that quietly builds serious wealth. On the other side of the ring, you have thematic ETFs. These are the trendy funds that focus on a specific niche, like artificial intelligence, clean energy, cybersecurity, or even robotics. They let you place a concentrated bet on an industry you believe is going to explode. Here's the catch. That concentration is a double-edged sword. A hot theme can give you incredible short-term gains, but it can also lead to gut-wrenching losses when that trend cools off. Thematic ETFs are almost always more volatile, and you guessed it, they come with much higher expense ratios. And look, the data on this is crystal clear. Over the long haul, boring, broad funds tend to deliver better results for investors than narrowly focused ones. So, what's the verdict for your first ETF? The choice is obvious. Start with a broad market ETF. This is the core of your portfolio, your foundation for stable, diversified growth. Once that foundation is solid, think 80 to 90% of your portfolio, then you can consider sprinkling in a small, speculative slice of a thematic ETF. But don't start there. Start with what's time-tested. Okay, theory's done. Let's get practical. How do you actually use these ideas to find your ETF? Just use this simple 3-filter system. Filter 1, the goal filter. Is it broad and boring? Your first filter is your goal. As a beginner, you are only looking for broad market index ETFs. When you're on a brokerage website, look for categories like large cap, S&P 500, or total stock market. You want a fund that tracks a big diversified index. If an ETF is called something like the Next Gen Quantum AI Innovators Fund, it fails this filter. Hard pass. If it's called something like Vanguard S&P 500 ETF, VUO, or iShares Core S&P 500 ETF, IVV, it passes. The next step. Filter 2, the cost filter. Is it cheap? Once you have a list of broad market funds, your next move is to filter by the expense ratio. Sort that list from lowest to highest. Immediately get rid of anything over 0.20%. From what's left, focus on the absolute cheapest ones. Remember, when you're comparing funds that track the exact same index, a lower cost directly translates to a higher return for you. There's no prize for paying more for the same product. Filter 3, the sanity check. Does it have a track record? From the handful of cheap, broad market ETFs you have left, do one last check. Look at 3 things. Fund size, AUM. This is assets under management, or how much money is in the fund. Bigger is better here. It means the fund is stable and easy to buy and sell. Look for the heavyweights. Funds with at least several $1 billion in assets. Inception date. How long has this fund been around? You want an ETF that's existed for at least 5 to 10 years, proving it can do its job through good times and bad. Liquidity. Check the average daily trading volume. A high volume means it's super easy to trade. For the popular ETFs you'll be looking at, this will be a non-issue, but it's a good final check. After these 3 filters, you'll probably have 2 or 3 nearly identical fantastic choices. Popular examples that always pass are VOO and IVV for the S&P 500, or VTI for the total US stock market. At this point, don't overthink it. They're all great. The most important thing is to get started. If this step-by-step breakdown is finally making the world of investing click for you, do me a huge favor and hit that subscribe button. We drop videos just like this every week to make finance simple and empower you to build your wealth. And let me know in the comments, which ETF are you thinking about for your first investment? You did it. You did the research, you beat the analysis paralysis, and you picked your fund. The final part, actually buying it, is the easiest step of all. First, you need a place to buy stuff. You can open an investment account online with a major brokerage in about 15 minutes. Seriously, it's about as complicated as opening a regular bank account. Once your account's open, you need to put money in it. Just link your bank account and transfer the funds over. You don't need a lot to start. Many brokers let you buy fractional shares, so you can get going with as little as $10 or $20. Place your order. Log into your brokerage account. Type the ETF's ticker symbol, like VOO, into the search bar. You'll go to its page where you can click Trade or Buy. You'll see order types like Market and Limit. For a long-term investor like you, a market order during trading hours is perfectly fine. It just means you'll buy it at the current price. Decide how much you want to invest, click Review, and submit your order. The most important step. You bought it. Now what? The most critical thing to do after buying your first ETF is almost nothing. Find the setting to reinvest dividends. It's usually just a checkbox. This automatically uses the dividends your ETF pays out to buy you more shares. Then, your job is to do the hardest part. Nothing. Decades, even. Don't panic and sell when the market dips. Don't check its price every day. Contribute money when you can, and let it grow. Choosing your first ETF doesn't have to be some monumental, terrifying task. It's about cutting through the noise and focusing on what actually matters. The formula is simple. Find a broadly diversified, incredibly low-cost index fund that matches your long-term goals. That's it. By following this guide, you've gone from confused to confident. You now have a repeatable framework you can use for the rest of your investing life. You didn't just learn what to choose, you learned how to choose. You are no longer on the sidelines watching everyone else. You are an investor.